Howdy everybody, Brian here from quantlabs.net. Today we are going to show you the next steps in all of the technical analysis stuff I've been working on, and I'm going to show you what they mean and what kind of trading decisions can be made out of them with automation. So first thing is, just as a historical, I do have now a channel that I've been working on with 47 videos, Bitcoin and cryptocurrency in there. And then you'll find in here all of the different views and technical indicators I'm using for what I'm about to show you to automatically build out charts and basically using computer logic to decide what is a good cryptocurrency pair and is good for, which is good for potential market entry. So here in the spreadsheet are all of the parameters I'm using. So I'm using 8 now. Actually, it's 6, 7, 8, 9, 10, 11, 12, 13, 14. But really, it's divided by 2. Here's why. First off, if you don't know, I'm using Binance as my data source for cryptocurrency pairs, on top of using Binance as the exchange for orders. Now, I'm not going to sit here and say it's the best or it's not. From what I've seen, it's most reliable for what I need. From what I've seen on my Telegram group, those folks suggest the same thing. It's one of the more popular exchanges out there, but it can always change as I use CCXT. I can swap out the data, kind of like a data adapter, and use a different exchange with a couple of modifications. But I will say right now, in summary, that Binance is the most easiest to work with, where you can download up to 1,000 data points or data rows, regardless of the frequency. So a lot of the other ones I've tried, more of the popular ones, have all kinds of weird limitations, and they only limit you at 500. You can't really go and do a lot with 500. But there is a weakness when it comes to Binance. Now, Binance does not give you the ability to look at weekly data. You either have hourly or daily or monthly or yearly. As far as I can tell, the yearly is kind of no good because, let's face it, the cryptocurrencies are really new, and a lot of them haven't been out for more than 2 years, so what's that going to do for you? The other one, the monthly, is just as bad. So I think daily is good, and hourly, those are the only ones that I have. I would also use a weekly, but it really comes down to daily and hourly. And the reason I don't use hourly or anything lower than hourly is just the charts. If you look at some of the more recent charts they put out historically, you will find even on an hourly basis, it's tough to trade because you get a buy signal, and then a minute later or within a couple hours, you'll get a sell signal. So really, when you look at that type of strategy, it's only really good for scalping. And scalping, I just don't know if it's the right way to trade at this point. But if you have a large account, you're market making, I'm sure it can do well for you. But when you're just a little person with a few thousand, you're not going to go very far with scalping. I find the commission fees and unpredictability and all that. And there's enough blabbing about that. So we got hourly, daily. So right now, I did a video on stats. To be honest, I'm not a huge fan of stats because you're always looking at historical data. The only thing that comes really useful out of it is what I call positive momentum and standard deviation. Standard deviation is important, but I'll explain that in a minute. As for the right here, what you're looking at are data from I believe last Thursday or Friday, and these are the stats for these particular cryptocurrency pairs off of Binance that would be wise to go with on positive momentum. So here we have hourly, and here we have daily. There's a couple of things I need to fix up here. Is how far back do I go? Because if you were to look at Bitcoin USD, you would find that that would also include all the historical anomaly stuff that happened in 2017, where Bitcoin went from 500 a year, all the way up to around 19 or 20K. So all that data is included. So it's going to skew this data. So I'm going to have to change probably a look back. I'm not sure how far back, but just to keep everything even. But so this does throw off the stats. So from my point of view, I probably ignore this one. But these other ones might be worth. I haven't really investigated or dug deep into them. But just from the stats alone on positive momentum, there are more positive moves with these pairs. Okay, so Salt and Tether, I believe. I don't know. Oh, sorry, Salt and Ethereum, Neo, so on and so forth. So this is an hourly move, and that's just the daily. Then we move into the stats again. Because we're dealing with a cryptocurrency, it never closes 24/7. The standard deviation becomes kind of permanent because what happens is you get huge price swings. As a result, like just Ethereum went 5% in a day, I believe. I don't know. But it's pretty wild. And one thing I have confirmed is you want to go with the least volatile. The least volatile. So that's where we do the analysis. Use the standard deviation. Again, we have the daily and the hourly moves. So these are the least volatile. Now, there's over 315 currency pairs in the lot. So typically you want to use ones that give you the volume or liquidity, so you can get virtually no fills or fast fills when you enter or exit the market on these pairs. That's another big factor. Slippage, and depending on the currency exchange that you're with as well. That's just something totally different outside of this. So again, we want to make sure we go with the least volatile of the lot. Again, that depends on your risk profile. So if you want to go crazy, you can do that and rank the opposite of the most volatile. I don't think you'll do all that well, but maybe go one where you go with the middle range of the volatile bunch. You do that as well. So this one's important because in one of my videos using moving average crosses, I don't know which video it is, but there's some long ones here. Maybe this one here, auto head shoulders with indicators, reveal some algo trading gems. I think it's this one. I learned, when you go through these, you learn so much about the nuances of how the flow of, as I call it, flow capital with these cryptocurrencies. And you find some interesting trends that I just haven't been able to dig up anywhere else. So one of them is the buy signal. So virtually all we're doing is watching a 20-day and a 20-day simple moving average against a 50-day. And all we're really doing is just measuring that and measuring that as a buy signal. Okay? Now, that may be very simplistic, and it is. That's why we have all these other column parameters to cross-check with each other, make sure that we're not getting a false positive, as I like to call it. So, or another way to say a false signal. So this one will generate a lot. Now, if you were to watch this on an hourly basis again, the little up and down arrows, red and green, and did this on hourly, as I said, you can only really, the only way is just to scalp. And a lot, I don't know about exchanges, but I know a lot of forex brokers don't like that, so they get ban you from doing that. So then we get into the juice of it all. This is kind of like the secret sauce if you're listening this far into the video. Between these two and these two, it looks like, I can't say for sure, but from that same video I shown you here, this hourly video, in there it was revealed that between this and this, I would say it's hard for me to give you a percentage of accuracy, but it was very high. It was beyond high. It was like confident high. So because of that, between these two, these are really good. So what am I talking about? We got the buy signal on the daily, right? And then we have what we call a long harmonic pattern. Just want you to know, all of this will only be used for longing only. I have a script that will measure on expected sharp, expected sharp, Sortino, which includes the volatility, which is more useful than sharp, if you ask me. So what we've got here, if you have not seen my harmonic pattern stuff, this is really where I have not yet seen a Python script or even an R script that does this as well as the one that I've custom coded. A while back, I did a webinar on this, and I've deleted it now because of this, because I didn't think it would work as well as it does, and it works great. So what I'm doing is I'm looking for harmonic patterns, long only, as I said, and all is just yes or no. So we're able to measure right at the last portion of when that pattern completes, meaning we have a bear or bullish signal on using a Gartley, a bat, butterfly, or an ABC, and then I think there's another one, ABC equals CD, on those moves. And those are historical moves that can be used to estimate historically on this pattern. We expect this to happen. But when you combine it with those moving averages and the buy signal, what I do now is I want to know if I'm getting a buy signal here, how far off is that from the completion of the long harmonic pattern? And what I find, if it's within a few days, depending if it's the daily stats that I'm using, or sorry, daily data, that with a high probability is an actual, filtered out all the other crap, it is a real buy signal on a daily chart or daily data. Okay, so that's something I discovered, and it works pretty good. But I got to test more of it. And then we come into the other ones, which are important, is standard, the Fibonacci gold range. And I've talked about that a few times in past videos. Again, you'll notice I don't go into detail about them because I would expect you either to be following along what I'm doing, or you would have it upon yourself.
Introducing Doubleberry.
That's right, I'm push wrong buttons. I would expect you to be able to have the ability to either Google it or go in my past videos or blog or whatever to get that information. So I'm keeping it very high level here. I'm not here to teach you each of these in great detail. So once again, in the Fibonacci, in the gold region, is the price, the latest price in that gold region? Yes. Now you can use Fibonacci retracement in numerous ways. You can use it for targeting your price. You can target it to combine it with support and resistance, so forth. But here in the gold region, it's beautiful because if it's in that gold region of the two levels of the Fibonacci levels, you can use that for evaluating where the price is, and you can value that historically. This is where I'm going to be struggling with: is how far do I look back to measure that historical pattern to get things like Fibonacci. Okay, so if I know that Fibonacci level on the price is within that gold range, then that is a good time to buy. Actually, it can be undervalued or within the gold range. It doesn't matter. I just don't want to buy it when it's too expensive. So in this case with a Fibonacci retracement, I'm only using it for valuation. That's it. But as I said, there's a lot more diverse characteristics you can get out of the Fibonacci retracements. Many more. The other thing is I'm using is yes or no, and depending upon the slope of the trend, I can measure on the profit potential historically. With the uptrend, what I can gather is the price either really close to approaching that trend and break through, and again, historically measured by whatever look back out I choose in comparison to here and all the way back here. Statistically, how far is that uptrend? And when you look at that trend, what we need to know is that going to become profitable, and usually it is if you look at the uptrend and it's reaching that, breaking through that trend line. This one again is a combination with this one. I just mentioned it. If there is positive momentum here using these guys, right? What is the odds of that price to break through the trend line? So I want to know how far it is below, because when you look at capital and you have, let's say, $1,000 you're willing to pay out each day for trading, just $1,000, make it easy, or $100. Wouldn't you be rather putting your capital for that day into trading opportunities or entries that are going to give you higher probability of profit? So you got to understand that there's going to be different measures of trading opportunities. Those are ones that are about to happen today. There's going to be ones that may happen in a few days, and there's going to be ones that, well, they may actually turn into something, but we don't know. Where would you rather put your money that you're going to trade for the day? So you need to ensure that when you deploy capital each day, that you are going to essentially make sure that when you deploy capital, you're choosing the optimal trading opportunity that will give you the highest rate of return for that day, or at least for that position. So that's what we need to measure. So we're going to have different statuses of these entry opportunities, and the ones that we really want are the ones that have the highest rate of return and the expected rate of return based upon history on all these indicators, as well as if you're how far below the trend line. If you're going to break through, we want to be in there when you cross that trend line to get maximum opportunity. But guess what? It may never break the trend line. So therefore, we need to measure, will it break through the trend? Maybe, maybe not. And if it doesn't break through the trend, obviously we don't put the position on, but it may break through later. We don't know. So we need to measure these on all levels. Now, again, it's really important that I probably going to be watching more of a focus on the daily data versus the hourly, as I explained earlier. Okay, so the next one is moving average. How far away? I'm sorry. The moving average, because you understand that crosses, if it's a 200-day moving average, EMA, I might say, exponential, versus a 20 or 50-day. This is what I've learned using these moving averages. The EMA is great because it's a long-term trend, and it's the absolute ultimate measurement to say, yes, we have something happening. It's breaking out because it's broken the EMA, the 200-day long-term EMA, which is a slow-moving one. So once you break that, you have a breakout, and a classic breakout, meaning money will be thrown at you. You know what I mean? But yet, you need to understand the difference between the difference between a simple moving average and an exponential moving average. What I've learned is simple moving averages are much, much more responsive to pricing changes, okay? But they're too sensitive. But they're fine for a 20 or 50-day moving average, but they're not going to be useful for you on the exponential moving average. Whereas the exponential move is lagging. So that's where you use a 200-day exponential moving average. Okay, so in this case, all we really care about, are you breaking the crosses of the 20 and 50-day simple moving averages? That's all that means, and how far off is that happening? Because I have seen literally, when I say this, 100% confirmation that you have market opportunity. You may make a few pennies, but usually when those crosses happen, you're going to be able to make a little bit of money. But you need to combine them with other indicators, as we're doing here, and I'm showing you that. Okay, the other one is built off of the the harmonic pattern, and I've been able to try this out. Last week I completed the inverted head and shoulder, and this is all automated. So the automated head and shoulders is just another way. And again, it's not 100%. It's probably from the other script that I've seen, again, built in Python. It's the range of it working is 40 to 60%, and the inverted can work as well. Now, when you measure a regular head and shoulder versus an inverted, what you'll find is that the head and shoulder is useful, but it's more of a confirmation when you look for those little green and green and blue dots that I created. Let me just go back and show you what I refer to in the videos. In these videos, if you look for the automated head and shoulders, what I've developed is just virtually blue and green dots. And what they mean is if it's on an up move and you expect it to move up, there's the neckline, and the difference between that and the green dot is what we expect the move to be, the peak of that move. That's what we expect. And the blue dot's the opposite when you do shorting. So those type of opportunities come up quite a bit, but a lot of them are false. And again, you need to cross-reference them with other indicators. That's what we're doing here. So that's one. And it's a very helpful tool or indicator to use for breakouts. And they're really good. Again, if you watch that long video here, I just posted this hourly. It's almost an hour. This one here, this shows you a lot of interesting things. But again, you got to watch a lot of them. And then here's the other one I'm referring to: the auto head and shoulders with other indicators reveal some algo trading gems. So you'll get an understanding of that in that video on the blue and green dots. But as I said, there's also the inverted. They don't happen too much. Out of 315 currency pairs, I might have gotten 3. So you're looking at a 1% approximation of that happening. But what this can be also used for is conditions for market reversals. But again, we can measure that through a variety of other tools, if it's a crosses on the moving average or whatnot. So that's pretty well it. I wanted to show you on this fun stuff. We really got, when you look at the nitty gritty, it's probably like 6, maybe 7 indicators combined to verify that. But with this spreadsheet, this will be automatically generated, automatically calculated, and it's going to go in and try to pick out what the best trading opportunities are at that time for basically cryptocurrency pairs, which would be really useful. I can run this hourly. I can go even lower on less than an hour, but as I said, I just find with the kind of portfolio I'm starting with, which is pretty well nothing, daily, more slower moving, smooth out the noise with the hourly and a lot of the false positives that you get with that. It's not a smart way to trade, because you'll be losing more money than you want and willing to tolerate. So there you go. All that's shown, and out of this, the ultimate end game is to get, as I said, which will be the optimal cryptocurrency pairs to buy on Binance at that point. And we shall talk to you later.